When qualifying for a low or no down payment loan such as an FHA or a VA mortgage, it's common for borrowers like you to unintentionally overlook the additional costs that come along with these types of mortgages. In this video, I'm going to explain what those additional costs are and the impact they have on your home's equity. So FHA and VA mortgages are great options for borrowers looking for low or no down payment options to purchase a home, but it has to be a primary residence if using these programs. That means you're in most cases a first-time home buyer and have less experience with the home buying process. So it's important to know negatives that come along with these types of programs. However, there are also many positive aspects to these types of loans that often outweigh the negatives. It's important you understand what these are, since it will reduce the amount of equity you have in your home, meaning less money in your pocket when the time comes to sell. So FHA mortgages have an upfront mortgage insurance premium, which is equal to 1.75% of the amount that you borrow, which is called your base loan amount. So if you borrowed $400,000 using an FHA mortgage, you would actually owe $7,000 more on that home than if you used a conventional mortgage to borrow that same $400,000. And I came up with that $7,000 number by taking your $400,000 base loan amount, multiplying it by the 1.75% upfront mortgage insurance premium. This equals $7,000. Now, the $7,000 can be rolled into the loan and not paid out of pocket, but you still owe the money. So when you sell or refinance, it will need to be paid off. Now, with a VA mortgage, unless you're exempt with some sort of service-connected disability, you're going to pay a VA funding fee. So if it's your first time using a VA mortgage, the funding fee is equal to 2.15% of the base loan amount. So once again, on a $400,000 loan, the VA funding fee would be $8,600. And just like an FHA upfront mortgage insurance premium, this too can be rolled into the loan. However, you still owe $8,600 more on that home than if you used a conventional mortgage. So if you were to compare this to a conventional mortgage and you took that same amount of money that you're paying up front in these hidden costs, you can use that money toward paying for your mortgage insurance, getting it out of your monthly payment and reducing your overall monthly payment. Or you can even use it to go ahead and buy down the interest rate on the conventional mortgage, resulting in a lower monthly payment. So by knowing about these additional costs up front, you might figure out ways to use those funds in other ways rather than necessarily using them to go with an FHA or a VA mortgage. So if you enjoyed the money saving tips in this video, please subscribe for more just like this one. Also, don't forget to leave a comment about your specific scenario or any questions you might have from the information I just discussed. I respond to 100% of the messages I receive.